Background of artificial intelligence in fintech sector, which means first of all we know that what is artificial intelligence in finance. Artificial intelligence in finance is transforming the way we interact with money. AI is helping the financial industry to streamline and optimize processes ranging from credit decisions to quantitative trading and financial risk management. And why we use artificial intelligence in finance means artificial intelligence is leading the front of the digital transformation strategy in finance today, using AI to improve core banking operations and tailor services will deliver over $250 billion in value across the industry. And when we use the artificial intelligence in finance means AI helps finance companies in resolving human problems by efficiency. AI improves results by applying various methods derived from the various aspects of human intelligence at a beyond human scale. The computational arms race of the last 2 decades has revolutionized the fintech companies. And how we use artificial intelligence means AI assistants such as chatbots use artificial intelligence to generate personalized financial advice and natural language processing to provide instant self-help customer service. Here are few examples of companies using AI to learn from customers and create a better banking experience. And we also know the 5 ways of AI is transforming the financial industry. They are first of all, as global technology has evolved over the years, we have moved from television to the internet, and today we are smoothly and gradually adapting artificial intelligence. It involves a lot of the main things ranging from process automation of robotics to the actual process of robotics. It has become highly popular among large enterprises today owing to the amount of data these companies are dealing in. Increase in the demand for understanding the data patterns has led to the growth in demand of AI. AI processes are much more efficient in identifying data patterns than humans, which is beneficial for companies to understand the target audience and gain insights. Basically, AI is of two types, weak AI and strong AI. Weak AI, which can also be described as narrow AI, is the system which is set up only to fulfill or accomplish a particular task. And strong AI, also known as full AI, has much bigger prospects than the weak AI. It is artificial intelligence that has huge capabilities and functionality. And the 5 ways how AI has transformed the finance industry are: first one, risk assessment. Since the very basis of AI is learning from past data, it is natural that AI should succeed in the financial service domain, where bookkeeping and records are second nature to the business. Let's take the example of credit cards. Today, we use credit score as a means of deciding who is eligible for the credit card and who isn't. However, grouping people into haves and have-nots is not always efficient for business. Instead, data about each individual's loan repayment habits, the number of loans currently active, the number of existing credit cards, etc., can be used to customize the interest rate on a card such that it makes more sense to the financial institutions that is offering the card. Now, take a minute to think about which system has the capability to go through thousands of personal financial records to come up with solution. And second one is fraud detection and management. Every business aims to reduce the risk conditions that surround it. This is even true for a financial institution. The loan a bank gives you is basically someone else's money, which is why you also get paid and interest on deposits and dividends on investments. This is also why banks and financial institutes take fraud very seriously. AI is on top when it comes to security and fraud identification. It can use past spending behaviors on different transaction instruments to point out odd behavior, such as using a card from another country just a few hours after it has been used elsewhere, or an attempt to withdraw a sum of money that is unusual for the account in question. Another excellent feature of fraud detection using AI is that the system has no qualms about learning. If it raises a red flag for a regular transaction and a human being corrects that, the system can learn from the experience and make even more sophisticated decisions about what can be considered fraud and what cannot. And the third one is financial advisory services. According to the PwC report, we can look forward to more robo advisors as the pressure increases on financial institutions to reduce their rates of commission on individual investments. Machines may do what humans don't, work for a single down payment. Another evolving field is bionic advisory, which combines machine calculations and human insight to provide options that are much more efficient than what their individual components provide. Collaboration is key. It is not enough to look at a machine as an accessory, or on the other end, as an insufferable known it all. An excellent balance and the ability to look at AI as a component in decision making, and that is as important as human viewpoint, is the future of financial decision making. The fourth one is trading. Investment companies have been relying on computers and data scientists to determine future patterns in the market. As a domain, trading and investments depend on the ability to predict the future accurately. Machines are great at this because they can crunch a huge amount of data in a short while. Machines can also be taught to observe patterns in past data and predict how these patterns might repeat in the future. While anomalies such as the 2008 financial crisis do exist in data, a machine can be taught to study the data to find triggers for these anomalies and plan for them in future forecasting as well. What's more, depending on individual risk appetite, AI can suggest portfolio solutions to meet each person's demand. So a person with a high risk appetite can quote on AI for decisions on when to buy, hold and sell stock. One with a lower risk appetite can receive alerts for when the market is expected to fall and can thus make a decision about whether to stay invested in market or to move out. And the fifth one is managing finance. Managing finances in this well-connected and the materialistic world can be challenging task for so many of us. As we look further into the future, we can see AI helping us to manage our finances. PFM, Personal Financial Management, is one of the recent development of the AI-based wallet. Wallet, started by the San Francisco-based startup, uses AI to build algorithms to help the consumers make smart decisions about their money when they are spending it. The idea behind the wallet is very simple. It just accumulates all the data from your web footprint and creates your spending graph. Advocates of privacy branching on the internet may find it offensive, but maybe and this is what lies in future. Thus, it has to be preferred personal financial management in order to save time from making lengthy spreadsheets or writing on a piece of paper. From a small scale investment to a large scale investment, AI commits to be a watchdog of future for managing finances. Without a speak of doubt, AI is the future for the finance industry, since the speed at which it making progressive steps towards making the financial processes easier for the customers. It is very soon going to replace humans and provide faster and much more efficient solutions. Bots are gradually evolving as innovations are being in the AI sector. Massive investments are being made by the firms who are seeing this as a long-term cost-cutting investment. It helps the companies in saving money of hiring humans and also avoiding human errors in this process. Though it is still in its nascent stage, the speed at which it progressing to evolve the finance sector, it can be well expected that the effect is going to lead to minor losses, smarter trading, and of course, top-notch customer experience. That's it from my side.
Okay, now I want to start. Fintech, the abbreviation for financial technology, is a broad category that refers to the innovative use of technology in the design and delivery of financial services and products. The application of fintech cuts across multiple business segments, including lending, advice, investment management, and payments. Many fintech companies harness mobile technologies big data, and superior analytics to tailor products for various customer segments. Banks are, of course, major users of technology. However, fintech puts technology at the heart of the financial services, offering fundamentally changing the way in which companies interact with their customers. This proliferation of fintech has a number of positive impacts for society, including increased competition, a reduction in prices paid by customers, and wider access to financial services among the traditionally underserved. And the evolution of fintech has only just begun. Both startups and traditional finance companies are active in fintech. These startups often don't look like a traditional bank or insurance company. They typically offer targeted solutions as opposed to begin one-stop shops for customer financial service needs. Many of these companies are based in tech hubs such as San Francisco, London, New York, and drawn on a workforce compressed of traditionally non of financial specializations such as computer science, engineering, or IT. Examples of fintech companies include TransferWise, an international money transfer provider, and alternative credit scoring service that leverages social media, and Ripple, an emerging payments network that leverages distributed ledger technology. Traditional banks, insurances, and other large financial institutions have increasingly invested in fintech as well. Some integrate fintech into their existing product and service offering, while others invest in fintech startups or set up their own fintech incubators. As CNBC noted, uh, is the largest of all banks with 13 startups backed from 2011 through 2015. Goldman Sachs with 10 startups backed, and JP Morgan Chase with 5 represent other Wall Street leaders in fintech boardrooms. The question of how fintech is and should be regulated is currently the subject of much debate, as fintech startups generally do not operate like a full fledged bank or insurance. They tend not to be subject to the same regulations that grow and more traditional players in the financial system. Not surprisingly, the existing regulatory framework is geared towards supervising from traditional financial services providers who can be more easily categorized as banks, insurances, and asset managers. Fintech provides do not neatly fit into the paradigm. In addition to the Federal Reserve, you have the Consumer Financial Protector Bureau, the Financial Industry Regulatory Authority, Securities and Exchange Commission, Office of the Comptroller of the Currency, Federal Deposit Insurance Corporator. As a result, this has led concentrated effort on behalf of policy makers to understand these new operating models and to reconsider the existing supervisory framework in light of fintech. The imperative is to strike the right balance between innovation and financial stability. How is the World Economy Forum contributing to the topic? In short, the new paper, prepared in collaboration with Oliver Wyman, pro- proposes 4 recommendations for the private sector and financial supervisors aimed at safeguarding financial stability and forecasting fintech. The recommendations are debate the ethical use of data to clarify the boundaries on the use of customer data for business purpose by actors in the financial system, set up a forum for public private dialogue on transformation to identify areas where supervisor support is needed to develop technology for enhancing stability. and monitor and understand fintech innovation in a consistent way to ensure that national supervisors are well equipped to mitigate risks arising from fintech. That's it from my side.
Let me continue. Let us see how this fintech evolved. Fintech is very broad. Most people hear fintech and think about the latest mobile app which can help them pay for their morning coffee without ever swiping a card or touching currency. But technology has always played a key role in the financial sector, and it evolved as fintech financial technology. So in examining the timeline of fintech developments in the last 65 years, this shows a rapid development. The 1950s brought us credit cards to ease the burden of carrying cash. The 1960s brought ATMs to replace tellers and branches. In the 1970s, electronic stock trading began on exchange trading floors. The 1980s saw the rise of bank mainframe computers and more sophisticated data and record keeping systems. In the 1990s, the internet and e-commerce business model flourished. This result was the introduction of online stock brokerage websites aimed at retail investors, replacing the phone-driven retail stock brokering model. These 5 decades of development have created a financial technology infrastructure which most people never think about it, but use almost every day. It's also important to note that throughout that 50-year period, fintech developments were also creating more sophisticated risk management, trade processing, treasury management, and data analysis tools at the institutional level for banks and financial services firms. While these systems are not apparent to retail banking customers, they make up a multi-billion industry aimed at supporting the needs of the financial service sector. Bloomberg, Thomson Reuters, SunGard, and Macy's are just a few of the players that make up the existing set of large fintech companies that have built this institutional infrastructure. What is striking about the last 65 years of development in these technology is that while they become mainstream and widely used by banks and their customers, the banking sector was not threatened. On the contrary, banks grave in looking at the USS FDIC data from 1950 to 2014. The number of bank branches in the country grew from approximately 18,000 to over 82,000. Now, moving on to the fintech services today, now in the early part of 21st century, retail financial services are being further digitized via mobile wallets, payment apps, robo advisors for wealth and retirement planning, equity crowdfunding platforms for access to private and alternative investment opportunities, and online lending platforms. The fintech services are not simple enhancement to banking services, but rather replacing banking services completely. So fintech can be thought of in two broad categories: consumer facing and institutional. It it is these consumer facing fintech services which are quickly gaining customer and competing with banks. As our target is banks, in the last couple of years, many fintech sector commenters and watchers have pointed to the coming demise of banks. Several have questioned whether banks will exist in future, as the data shows retail banking has flourished up until now. But this most recent evolution in fintech may change the banking landscape in some markets. Now let us see what is the role of banks. Questioning or predicting the demise of banks boils down the understanding the role that banks play in different markets and regions. At the basic retail and consumer level, banks collect, deposit, and make loans while also facilitating payments and currency exchange in most developed countries. The majority of households have at least one bank account which they use as their central hub for receiving paychecks, making payments, and saving money. But this isn't the case everywhere. In underbanked or unbanked regions, primarily in parts of Asia and Africa, many individuals hold their life savings in cash without bank accounts. To capture this distinction more broadly, in developing countries, banking penetration is approximately 41% compared to 89% in developed countries. In India, for example, the country has approximately 1,02,000 bank branches for a population that is roughly 4 times that is of US, which has approximately 82,000 bank branches. Fintech startups that offer secure mobile wallets and payment apps are allowing these unbanked populations to safely store their money and make purchases without having to worry about storing or carrying large amounts of cash. Google Pay is probably the most successful example of such app. In Kenya, the company touts a very strong user base and the mobile wallet has become a daily used utility for purchases. This eliminates the need of a bank account among those users who don't have complicated finances. Similar fintech apps may become the de facto saving pool for those without a bank account. This type of dynamic allows smaller fintech startups to play a role of banks by helping people to borrow, spend, and pay using mobile apps and websites, bypassing banks altogether. In these markets, a standard banking landscape is a very real possibility. In the US, fintech apps such as Venmo and Apple Pay provide convenient and secure payment methods. They are faster and cheaper than transferring money between bank accounts and using checks. Millennials are habitually paying each other or making purchases with such apps. For example, in India, many of the people we use GPay or PhonePe for our transactions, day-to-day transactions. We avoided carrying cash with our own hands. Lending platforms such as lending clubs and Prosper provide lower interest rate personal loans with a maximum limit of $35,000. Robo advisors are here comes artificial intelligence and robo advisors are providing an alternative to traditional financial advisors. Companies such as Betterment and Wealthfront provide a data-driven automatic investment plan for retirement planning and wealth management. All of these fintech companies are strong contenders who are increasing their market share and competing with retail banking services. But the truth is, bank accounts are still where paychecks get deposited. The deposit based sites with a bank where it funds payment apps, loan payments, and investment accounts. Banks provide a level of insured safety when deposits are too large to particularly sit in mobile wallets. Eventually, as people buy homes, buy cars, and pay for college, the financial needs become more complicated and require larger borrowing limits. At some point, consolidating services through a bank account becomes an attractive option. While there is no doubt that consumer focused fintech startups are catching market share through the efficiency and speed they offer, it is difficult to imagine a further way banks completely disappear in developed markets. So what we have to do is we have to target the people who come from a background of banks, and we should ensure that they trust us. We can provide all the services they want, and they can deposit a large amount into our accounts. So this could help us in a way we could replace banks, and we can gain the trust of people. So that's it from my side.
सुनिए आता है रे
Ah,
fintech is improving and it's good thing for consumer and financial service have become much bigger percentage of the economy in the United States. More interest and capital is being into improving finance services technologies known as the fintech. There have been many great recent innovations that provide better information opportunities and ultimately return for investors. The month we take look in the fintech industry trying to do affects investors, the economy a whole. A little background: fintech traces roots back the start. Modern security technology has played significant role of the fintech sector. Think about the most modern financial services utilizes the stars. The cat's credit card were developed by 1950s. Burden the security risk of carrying cash when it was not complete. Practical eliminate cash innovation where we made the develop automated teller machine, that is ATM, withdrawal cash quickly without hassless with spreading line bank. In 1970s saw the further innovation using a new communication technology stock market that had the function of trading fixed security commissions of decades become the electronic for the first time established shift was soon established fixed problems trades where fintech was the up to not 1980s with the established the first online banking system, the first online catalog shopper, the personal finance database by the mid-late 1980s. By the time of the internet, like PC before the became entered household step, fintech has been established in 1998, largest commercial bank when the consider the technology has the made easier it move money telling that had made it easier invest money would not be the surprise today people have resource available if their capital made faster financial decisions response instructions have used improvement current fintech. So we have moved on to the first part of 21st century people is able to advantage of the remote computing through use the smartphones use being the innovation working of individual much you see in working of financial service organization these innovation are not necessarily turn way of the fintech traditional focus institution of the banking but elegant with the overall the increase the individual engagement that's not easy become the more innovation popular fintech application working in the direct with the traditional banking institution, the past couple years have been fintech application becoming more popular at the expense of the established leading institution. Think the like capable companies losing their market share, streaming companies, many capable companies are losing the customer because of their reliable alternative, which was the turn has seen change their strategy to make more attractive consumers. Banking has not had adjust to the developed by quit developing world money transfer financing the microfinancing application circumstance of traditional banking institution. The futures of the fintech is nothing but emerging technologies are not going huge part of money for future. No more this event blockchain cryptocurrency currently there is the over 1600 different cryptocurrencies but the success is Bitcoin. It is the major boom investment of the cryptocurrency. The technology which effectively shared encrypted database transformation cannot be alternate hold both the potential huge returns of many prawn investors. Blockchain raised the nearly $250 million venture capital much it said come from the banks. What are banking start to alternative for the blockchain? Some suggest efficiency, clearing, and statement costs save the banking institution multiple billion dollars per year. Other application being considered the overall include payment system, trade finance, identify system, bank use, keep payments, private secure. Fintech one of the biggest question mark about the fintech surrounds innovation percent technologies since may of these new financial technologies being developed essential complete traditional banking institution. So that's it from my side.